Nancy, how concerned are you for any kind of US recovery in 2021?
Well, I do think the markets are pricing in a recovery. People are pretty optimistic in financial markets that the real economy will be able to catch up, and we'll see, the vaccine, and we'll get herd immunity, and we will be able to get out of our house and go back to normal life without masks at some point. So I am optimistic, but it's obviously, no one's ever done this before, and we hope the vaccine works.
Do you have any kind of assumptions for GDP growth or inflation?
So we do think inflation is pretty unexpected right now. We do think, we have kind of all of the recipes, whether it's fiscal spending coming, more quantitative easing, the economy really coming back to life. And I do think you haven't really seen inflation since the 70s, and this could be the perfect recipe to actually achieve that outcome that central banks around the world have been trying to do for years, and it's been elusive so far.
That said, the central bank in the US isn't looking to raise rates anytime soon. The dot plot shows years before the Fed even thinks it's going to be raising rates. Bloomberg Economics has the first rate increase in 2025, Nancy. Is that realistic?
I do think it's realistic. I don't think the Fed wants to be hiking rates. You actually, that's exactly what you need to kind of stoke inflation. Is you need a central bank who's going to let the economy run hot. I think the Fed's new soft inflation targeting is just a sign that they see inflation as symmetric, and they want it to be noticeably above 2% before they start to cool the economy. So I think it's actually the perfect catalyst to actually get inflation going, is having everyone thinking the central banks will be on hold forever and having them let it run hot.
Now, Nancy, you run an interest rate volatility product, the Quadratic Interest Rate Volatility and Inflation Hedge ETF. How do you run that in an environment like this?
Well, Ivol, which is the ticker IVOL, not eyeball. It's an inflation protected fund. We use inflation protected treasuries as a primary base for the strategy. It's about 85% in treasuries with inflation protection, and then we augment those treasuries with options that access the what we think is a different measure than CPI inflation. The big challenge that we see is we've never had inflation, since the U.S. Treasury created the inflation protected bond market in the late 90s. Treasuries with inflation protection, they are long duration, right? So if we do have higher yields, they can lose. And then also the only measure of inflation is linked to the CPI basket, which may or may not be the right measure of inflation. So we think it's important to augment a regular TIPS portfolio beyond just that CPI inflation.
What happens when some of this relief gets into the economy, but there's nothing for states and local governments, Nancy? Does that have an impact on the way you see markets behaving next year?
So we do expect the fiscal spending to directly go to states and governments. That's a way of, transmitting the flow of money from the central bank to the real economy. We also think there will be more, we need a healthy upward sloping yield curve to incentivize lenders to lend. But we also don't want to create another property bubble like what we had in the 2008 financial crisis. So it's very
But
important.
Nancy, explain that a little more. How on earth are you anticipating a property bubble next year? Do you mean in certain cities and in certain areas? Because there are very definitely areas where that's the opposite of what's going to happen.
So interest rates are very linked to property prices. When you have very, very low level of interest rates like we do right now, it can incentivize borrowing. The Fed obviously wants the market to grow. It wants to transmit the money that's in the financial system to the real economy. But in order to do that, they really need lenders to extend credit. So you need to have lenders be incentivized to get money from the Main Street to the real economy. And the property market is very, you're seeing a de-urbanization right now where many people are leaving cities to go to suburbs or countries to have more room, given the work from home situation. So you do see a quite divergent, to your point, Bonnie, property market where some places are absolutely on fire and there's no inventory, whereas other more urban settings have lots of supply.